Going down, down, down. How far will home prices fall? Welcome to the Property Imperative Weekly to the 3rd of March 2018. I'm Martin North, Principal Analyst at Digital Finance Analytics. Yet another big week in property and finance for us to review today. We start with the latest home price data from CoreLogic. Prices continue to soften. On an annual basis, prices are down 0.5% in Sydney, 2.7% in Perth, and 7.4% in Darwin. They were higher over the year in Melbourne, up 6.9%, Brisbane 1.8%, Adelaide 2.2%, and Hobart a massive 13.1%. But beware, these are average figures, and there are considerable variations across locations, within regions, and across property types. The bigger falls are being seen at the top end of the market. Over the 3 months to February, Adelaide was up 0.1% and Hobart 3.2%. These were the only capital cities in which values rose. Sydney, which has been the strongest market for value growth over recent years, saw the largest fall in value over the 3-month period, down 2.4%. And Sydney was followed by Darwin, which had been persistently weak over recent years and fell by 2% over the quarter. Finally, CoreLogic says month-on-month falls were generally mild but broad-based. Over the month, values fell across every capital city except Hobart, which was up 0.7%, and Adelaide, which was steady, with the largest monthly decline recorded in Darwin, down 0.9%, and Sydney, down 0.6%. Values were low in Melbourne, down 0.1%, Brisbane 0.1%, Perth 0.2%, and Canberra down 0.3%. The reason for the falls are pretty plain to see. Demand is substantially off, especially from investors, as mortgage underwriting standards are tightening. So it was interesting to hear APRA Chairman Wayne Byres' testimony in front of the Senate Economics Legislation Committee. I discussed this with Ross Greenwood on 2GB during the week. During the session, Byres said that the 10% cap on banks lending to housing investors imposed in December 2014 was probably, quote, reaching the end of its useful life, as lending standards have improved. Essentially, it had become redundant. But the other policy, a limit of more than 30% of lending interest only, will stay in place. This more recent additional intervention, which dates from March 2017, will stay for now, despite it being a temporary measure. The 30% cap is based on the flow of new lending in a particular quarter relative to the total flow of new lending in that quarter. This all points to tighter mortgage lending standards ahead, but it does not address the risks in the back book. The mortgage underwriting screws are much tighter now, and our surveys show that about a quarter of people seeking a mortgage now cannot get one, due mainly to the imposed limits on income, expenses, and serviceability. During the sessions, Senator Lee Rhiannon asked APRA about mortgage fraud. This was, to my mind, the most significant part.
Rhiannon.
Thank you, Chair. In relation to your investigation into mortgage fraud, which APRA has not made public, has APRA found any evidence of illegal misconduct in the mortgage market by the major lenders?
So I wouldn't say what we've done is specifically a review of mortgage fraud. We've looked generally at lending practices across the board and the controls that banks have to make sure they get accurate information from borrowers, etc., and make a reasonable assessment of a borrower's ability to repay. Part of that are controls to make sure borrowers give true and fair information, but that's not the entirety of the exercise. The second part of your question, if I had it right, was have we identified any systemic...
Any evidence of illegal misconduct?
Illegal misconduct, not at this point. There's nothing that's been brought to my attention.
Well, brought to your attention? Is it anywhere else within the organisation?
Well, I'm sure if someone had something of that nature in APRA, I'd know about it.
Do you need to take it on notice?
I'm happy to take it on notice.
Okay, thank you.
Yet, even now, More than 10% of all new loans are being funded at a loan to income of more than 6 times. And whilst the volume of interest-only loans has fallen to 20% of new loans, which is well below the 30% limit, it seems small lenders are lending faster than the majors, and we know that the non-banks are going gangbusters. Now, the HIA said that their Housing Affordability Index saw a small improvement of 0.2% during December 2017, indicating that affordability challenges had, quote, eased thanks to softer home prices in Sydney, where they are now slightly lower than they were a year ago. So this makes home purchase a little more accessible, they say, particularly for first-time buyers. But they failed to mention the now tighter lending standards, which more than negates any small improvement in their index. The impact of this tightening came through in the latest data on housing finance from both the RBA and APRA. I made a separate video on this if you want the gory details. The RBA said that in January, owner-occupied lending rose 0.6% or 8% over the past year to $1.14 trillion. Investment lending rose 0.2% or 3% over the past year to $587 billion and comprises 34% of all housing lending. But they've changed the way they report the data this month, and it changes the trend reporting significantly. Since mid-2015, the bank has been writing back perceived loan reclassifications, which pushed the investor loans higher and the owner-occupied loans lower. They have now reversed this policy. So the flow of investment loans is lower and more in line with the data from APRA on bank portfolios, by the way, and investor loans suddenly dropped 2% magically. Once again, this highlights the rubbery nature of the data on lending in Australia. What with data problems in the banks and at the RBA, we really don't have a good chart and compass. It just happens to be the biggest threat to financial stability, but never mind. The latest APRA monthly banking stats to January 2018 tells an interesting tale. Total loans from ADIs rose by $6.1 billion in the month, up 0.4%. Within that, loans for owner occupation rose 0.57%, up $5.96 billion to $1.05 trillion, while loans for investment purposes rose 0.04% or $210 million. 34.4% of loans in the portfolio are for investment purposes. So the rotation away from investment loans continues, and overall lending momentum is slowing a little, but it still represents an annual growth rate of nearly 5%, still well above inflation or income, which is 1.9%. Looking at the lender portfolios, we see some significant divergences in strategy, with Westpac still driving investment loans the hardest, while CBA and ANZ portfolios have actually fallen in total value, with lower new acquisitions and switching. The Bank of Queensland and Macquarie are also lifting investment lending. Searching questions are now being asked about lax mortgage lending and the risks the banks are sitting on at the moment. While better lending controls will help ahead, we have a significant problem now with many households facing financial difficulty. First, there is the issue of basic cash flow. As incomes remain contained, costs of living rise, and mortgage payments still have to be met. We estimate that 51,500 households are at risk of default in the year ahead, a small but growing problem. We're going to release the February mortgage stress data on Monday, so look out for that. Then there is the question of banks and brokers not doing sufficient due diligence on loan applications. This is something the Royal Commission will be looking at in the next couple of weeks. We worked with the ABC on a story which aired this week looking at the issues around poor lending. It's a complex issue, of course, because borrowers have to take some responsibility for the applications they made for credit and need to be truthful. But both brokers and lenders have obligations to make sufficient inquiry into the applicant's circumstances to ensure that the loan is, quote, not unsuitable, which is nothing to do with the best mortgage, by the way. It's a much lower hurdle. But If a loan were deemed to be unsuitable, the courts may change the terms of the loan or even cancel the loan, meaning a borrower could leave a property without debt. An upcoming court case may clarify the law. But in the ABC piece, Brian Johnson, one of the best analysts in the business, said,
if a bank has provided credit to someone that can't reasonably pay it back, then the whole contract can be voided. So what that basically means is that it suddenly goes from being the borrower's problem, potentially being the bank's problem.
This also touches on the role of mortgage brokers and whether their commission-based remuneration might influence their loan recommendations to the detriment of their customers, which, by the way, is more than half the market. This is something which both ASIC and the Productivity Commission have been highlighting. Speaking at a CEDA event, Productivity Commission Chairman Peter Harris said that more than $2.4 billion is now paid annually for mortgage broker services. The Commission's draft report, released in early February, said that based on ASIC's findings, lenders pay brokers an upfront commission of $2,289 or 0.62% and a trail commission of $665 or 0.18% a year on an average new loan of $369,000. He zeroed in on trailing commissions, which he said were worth $1 billion per annum, and questioned their relevance. The Banking Royal Commission says the first round of public hearings will be held in Melbourne from Tuesday the 13th of March to Friday the 23rd of March. They listed the range of matters they are exploring, from mortgages, brokers, cards, car finance, add-on insurance and account administration, and with reference to specific banks including NAB, CBA, ANZ, Westpac, Aussie and Citi. Responsible lending is the theme. And talking of mortgage brokers, another question to consider is the ownership relationships between a broker, their aggregator and the bank. Not only are many brokers effectively directly employed by the big banks, but more have strong associations, and these relationships are not adequately disclosed. The New Daily did a great piece on showing some of these linkages, most of which are really hard to spot. They said that fans of Married at First Sight and My Kitchen Rules may have noticed over the past few days that popular property website realestate.com.au has started advertising a new product, home loans. But realestate.com.au home loans is not an independent initiative, far from it. It is a deal between Rupert Murdoch's News Corp, which owns 61.6% of realestate.com.au, and Big Four bank NAB. Last June, REA Group, the company behind the realestate.com.au website, signed what it called a strategic mortgage broking partnership with NAB. What REA Group is actually doing is piggybacking on a mortgage broker called Choice Home Loans. In other words, whilst the branding may be realestate.com.au, the actual mortgage broking firm is Choice Home Loans. And who owns Choice Home Loans? Well, NAB does. If you get conditional approval through realestate.com.au, it will be provided by NAB. However, getting conditional approval with NAB doesn't commit you to a NAB home loan. First, you could choose a realestate.com.au white label loan. This is a loan that on the face of it looks like it's provided by realestate.com.au. But again, appearances can be deceptive. REA Group does not have a mortgage lender's license, so while these loans may be branded realestate.com.au, they're actually provided by a nationwide mortgage lender called Advantage. And who owns Advantage? NAB does. And if you don't fancy the realestate.com.au home loan, there are other choices. First, there's a range of NAB mortgages. And then there's a list of mortgages from other providers, more than 30 of them in fact, including big names like Westpac, ANZ, Commonwealth Bank, Macquarie, ING, ME, UBank. The list goes on. Oh, and by the way, that last bank mentioned, UBank, is also owned by NAB. All of this highlights the hidden connections and the market power of the big banks. Like I said, these relationships are hard to spot. Another little reported issue this week was the financial viability of lenders' mortgage insurers in Australia. Those specialist insurers who cover mortgages over 80% of loan to value. QBE Insurance reported their full year 2017 results and reported a statutory net loss after tax. Now, this is a diverse and complex group, which is now seeking a path to rationalisation. They declared their Asia Pacific result unacceptable and said the strategy was to narrow the focus and simplify back to the core, with a focus on the reduction in poor performing segments. Now, to me, this begs the question, what is the status of their lenders' mortgage insurance business? They reported a higher combined operating ratio consistent with a cyclical slowdown in the Australian mortgage insurance sector, higher claims and a lower cure rate. Now, very little detail was included in the results, but this aligns with similar experiences at Genworth, the listed monoline, who reported a 26% drop in profit and provided greater insight into the mortgage sector. Both LMIs are experiencing similar stresses with lower premium income and higher claims. And this before the property market really slows or interest rates rise. And of course, the Productivity Commission also questioned whether they should be returning premiums if people moved subsequently. It begs the question, how secure are these external lenders' mortgage insurers? It's another risk to consider. Last week's auction preliminary results from Domain said that nationally, from 2,627 properties listed for auction, only 1,794 actually went to sale and 1,325 were sold. So the real clearance rate against those listed was 50.4%. Domain, though, calculates the clearance rate on those going to auction less withdrawn sales over those sold. And this gives a higher measure of 68.8% nationally, which is still lower than last year, by the way. But we ask, which is the real clearance rate? Finally, there's a rising chorus demanding that APRA loosen their rules for mortgage lending in the face of slipping home prices. This despite the RBA's recent comments about the risks in the system, especially relating to investor and interest-only loans. But this is unlikely. And in fact, more tightening, either by a rate rise or macroprudential, will be needed to contain the risks in the system. The latter, we think, is more likely. Some of this will come from the lenders directly. For example, last week ANZ said it will be regarding all interest-only loans up for renewal as credit-critical events requiring a full income verification from the 5th of March. If loans fail this assessment, those loans would revert to principal and interest loans, which of course have higher repayment terms. We are already seeing a number of forced switches or forced sales thanks to the tighter interest-only rules more generally. And we will release an updated set of numbers next week. But as ANZ pointed out in a separate note from David Plank, the head of Australian economics at ANZ, household leverage is still increasing, and this despite a moderation in housing credit growth over the past year. Household debt continues to grow faster than disposable income. And with household debt being close to double disposable income, it will actually require the growth in household debt to slow well below that of income in order for the ratio of household debt to income to stabilise, let alone fall. And in fact, he rightly questions whether financial stability has really been improved so far when interest rates are so very low. So nothing we have seen this week changes our view of more insignificant falls in property values ahead as mortgage lending is tightened further. This also shows that it is really credit supply and demand, not property supply and demand, which is the critical controller of home price movements. Another reason to revisit the question of negative property gearing, in my view. If you found this useful, please do like the post and add a comment. If you've already subscribed, thank you. I'm really grateful for your support. And if you are not yet a subscriber, please subscribe to receive future alerts. I'm Martin North, Principal at Digital Finance Analytics. Many thanks for taking the time to watch.